Good afternoon and good afternoon and good morning, everyone, depending on where you are joining us from. Welcome to the second day of our special 4-day webinar series, the Midway Mark, Reflection and the Road Ahead for 2025. I'm Nikki from Mysteel, and I'm honored to be your moderator for today's session, hosted by Mysteel and Horizon Insights. This series is designed to unlock a deeper, more actionable understanding of China's dynamic commodity markets by leveraging the distinctive strengths of both organizations. Mysteel stands as China's largest market intelligence provider, renowned for its first-hand database. Its proprietary Chinese database delivers the most comprehensive granular coverage granular coverage available, spanning the entire commodity value chain. Mysteel is committed to international data governance standards, ensuring the reliability and accuracy. Notably, it is the first IOSCO-compliant Chinese price report agency, guaranteeing regulatory compliance and credibility. Horizon Insights, as China's premier independent institutional research provider, is specialized in China's focused macro and commodity research, providing not only directional views on commodity prices but also actionable trading strategies. By leveraging their extensive domestic industry network and global reach, Horizon Insights help institutions make informed decisions and capture opportunities in dynamic markets. As we reach the halfway point of 2025, global markets continue to navigate a complex and rapidly evolving landscape. This year, we saw significant policy shifts, ongoing geopolitical tensions, and heightened market volatility. These challenges have also created opportunities for investors and traders to rethink strategies and identify new areas for growth. With the combined expertise of these two teams, we are here to help you navigate the complexities of the Chinese commodity market and make data-driven trading decisions. This 4-day event is designed to provide a comprehensive outlook for the year ahead. We will have another 2 seminars, the ferrous session on the 29th and critical materials, including copper and lithium carbonate, on the 30th next week at the same time slot. Today's focus is oil market in transition. This session explores the latest developments in oil demand and refining capacity, the renewed focus on market fundamentals, and how digital intelligence is shaping price forecasting practices. We are excited to bring together a distinguished lineup of experts from Mysteel and Horizon Insights. I believe their perspectives will help you navigate the road ahead with greater confidence. Before we begin, just a few quick housekeeping items. We have received quite a lot of questions before the webinar. Most of them will be addressed in today's session. For those are highly specific or broad in scope, we may not be able to fully cover them all today, but we will follow up with you after the session. In addition, we encourage you to leave questions into the Q&A box at the bottom at any time. Selected questions will be addressed during the last 10 minutes after the presentations. Today we have 3 speakers. The first part about market fundamentals will last about 25 minutes. And in the second part, we will have 2 speakers talking about short-term trade opportunities and strategies. If privacy is a concern, please feel free to rename yourself in the Zoom setting. Finally, a quick disclaimer. The content presented during this event is for informational purposes only and does not constitute for formal investment advice. Horizon Insights and Mysteel are not liable for any decisions made based on the information shared today. Please consult professional advisors for specific investment, legal, accounting, or tax matters. Without further ado, let's get started. To kick off, please join me in welcoming Amy Sun from Mysteel, who is the Senior Consultant and Project Manager of the oil refining value chain and investment feasibility studies with over 15 years experience in this field. Amy is also the product owner of China Oil Market Outlook Monthly, which is offering a rolling 12 months forecast on China oil supply and demand. So the floor is yours, Amy.
Okay. Hello, everyone. This is Amy from GL Consulting. I will be sharing our latest view on how China's refining landscape is expected to evolve over the next 5 years, what we are seeing in terms of key oil product demand trends, and how we think the market might move in the second half of this year. First, please allow me to start with a short introduction of Mysteel family. Founded in 2000, Mysteel is a Chinese publicly listed market intelligence and data company in the commodities industry. Starting from steel and raw materials, we have expanded into energy and chemicals through our subsidiary Allchem and GL Consulting with a total of 1,200 staff. In late 2017, Mysteel acquired Longzhou, known as Allchem, the first formation provider of China's energy and petrochemical market, established in 1988, formerly known as information arm of Sinopec. While GL Consulting plays a strategic role as a professional think tank team established in 2018, providing mid and long-term market analysis for China's energy and chemical industry. Okay, let's begin with a big picture over the next 5 years. China's major oil products have entered oversupplied phase. Supply side trends will be shifted more by downstream demand shifts and evolving policy trend. So we will start by reviewing the demand across key oil products first. As shown in the chart, naphtha demand mainly for the chemical feedstock will grow steadily through 2030, especially in the next 2 years, with our new cracking projects will coming online. Among transportation fuels, jet is the only one still seeing growth here, but the growth is slowing due to a higher base, saturated airport capacity, and expanding alternative like the high-speed rail. In contrast, gasoline and diesel are still declining, mainly due to the more EVs on the road and wider use of LNG and the new energy heavy-duty trucks in transportation sector. And the fuel oil is under the most pressure since late last year, 2024. Consumption tax rebate costs and higher import duties have hit Shandong Independence hard. Many have reduced their runs or shut down some capacity. So the imports of fuel oil dropped around 38% in the first half of this year, and the outlook is still weak. Putting all these demand together, the total demand of these products in both 2025 and 2030 shows a clear drop from 2024 levels. Sorry.
Yeah, I think there is a law.
Okay, is that okay? Sorry, I'm offline.
Yeah, I think 20. You stop at 20 something.
Sorry.
There are a few seconds missed out. The line.
Okay.
The network is...
Okay. Okay. I will repeat the latest content. Putting this demand of all product together, the total demand in both 2025 and 2030 shows a clear drop from 2024 levels. By 2030, we expect the demand to drop by around 12 to 13% from 2024 levels, which means there are continued pressure on crude oil demand, China crude oil demand from the refining sector. And this chart shows the major policies since 2018, broken down by segment: red feedstock, blue refining, green is distribution sector, and green is retail. We have seen a clear increase in policy intensity since May of 2021. From 2018 to 2023, most of the measures is in the distribution side, like tighter tax enforcement, crackdowns on blind stock related tax evasion and stricter licenses for storage and wholesale. But since 2024, the focus has shifted upstream, mainly on feedstock and refining. Key actions include the lower consumption tax rebates for fuel oil as feedstocks, higher import duties, and the port restrictions on high-risk crude like Iran or Venezuela barrels. There were market rumors in June about raising consumption tax rebates for some China pilot refiners up to 70%, but that didn't go through. So the rebate policy remains a key swing factor for independent refineries now. So looking ahead, we expect three main trends: stronger compliance push across the whole value chain, for the oil products, less support for product exports, and tighter controls on high-risk crude not covered by China's crude import quotas. These measures are shrinking the operating space for independents and accelerating the exit of non-compliant resources in the market or inefficient capacities. Another key policy to watch is a possible shift in consumption tax collection from the refinery gate to the end user level. If this policy implemented, this would close off the current gray margin in gasoline and diesel circulations, hitting the margins of blenders, traders, and non-blended refiners in China market. So we think this change will come within the next 1 to 2 years. Next, now let's turn to China's refining capacity outlook for the next 5 years, building on the earlier demand and policy discussion. The chart on the left shows our forecast, and the table on the right lists potential projects. Projects 1 to 9 already have online, is online in the first half of this year or have received formal approvals or under construction, all included in our forecast. But projects from 10 to 13 are still at the proposal stage, and given current policy direction, we are unlikely to receive national approval, so we exclude them from our outlook. And these progressing projects fall into three main categories. The first is capacity replacement, such as Yulong Petrochemical. Second is integrated expansion and upgrades like Zhenhai Petrochemical, Sinop Daxie, and Qilu Petrochemical, where new CDU capacity supports downstream chemical chains. The third is relocation, for example, Dalian Petrochemical, where the old 410 kbd site will be shut down and replaced by a smaller 200 kbd unit, driven by environmental and security and structural goals. And importantly, there are no new greenfield refineries are being approved under current policies. Instead, policy and demand pressures are accelerating the phase-out of inefficient capacities. So based on our estimates, China's total refining capacity likely peaked in 2024 at around 57 million tons per year. From 2025 to 2027, capacity is expected to remain flat, with new builds offset by the closures. By 2030, we forecast a moderate decline to around 937 million tons per year. Okay, now look at our latest forecast for China's gasoline and diesel demand in 2025. As of early July, we have revised our estimates. Gasoline demand is now projected to decline by 3.1% year-on-year, and diesel demand by 7.6% year-on-year, both significantly steeper than what the market expected at the beginning of this year. Two key reasons. The first is global macro uncertainty continues to weigh on China's domestic activity, macro environment, and second, the fuel substitution, especially for the EVs and LNGs, is picking up faster than expected, putting real pressure on the gasoline diesel demand. And break it down to by half, the gasoline demand is likely to stay flat in the second half of this year compared to the first half. And diesel demand may see a modest recovery, with volumes to up around 5.8% in the second half of this year. This recovery is supported by two factors. First is September to November, January, it is a diesel's seasonal high. And the second reason is that LNG price usually climb in Q4 due to winter heating needs, while crude oil price could soften. So giving diesel a relative cost edge in transport fuel, so supporting the short-term diesel consumption. And the biggest factor affecting gasoline demand is still EV substitution, thanks to the two new policies and stronger consumer stimulus. The auto market picked up notably after Chinese New Year. The local governments also rolled after some incentives and reopened the auto shows, helping retail passenger vehicles sales grew 10.8% year-on-year in the first half this year. That is 7 to 8 percentage points faster than last year. EV is maintained strong momentum, growing around 33 to 34% in the first half, supported by the scrappage trade-in programs and purchase tax exceptions. So the EV penetration is 50.1%, and we expect it to reach around 55% for the full year. Since gasoline demand is mainly tied to the end-use vehicles, so once EV substitution has scale, the drop in gasoline demand becomes long-term and irreversible, and the pace of decline will likely speed up. And the China's gasoline market has clearly moved into oversupply. Refiners are adjusting yields. The chart on the right shows the gasoline yield trends from 2010 through the second half of this year for the two majors, Sinopec and CPC, with Q2 data based on Ocam's market survey. Gasoline yields peaked in 2019 and 2021, then declined steadily. But since last year, despite the falling demand, both two majors have their use didn't slow down a lot, and even Sinopec has raised its gasoline yields. This is because over 95% of the gasoline demand comes from the retail stations, where these two groups have higher market share than their refining uphold share. So backed by the national pricing mechanism for gasoline and diesel, the gasoline continues to deliver solid margins across the value chain. So refiners are still motivated to produce more gasoline, especially with petrochemical margins under pressure. The chart on the left illustrates domestic gasoline crack spread trends. We use wholesale prices. Here are pre-tax prices, including consumption tax, VAT, and additional taxes. As of May-July this year, they are up around 7% year-on-year, holding in the $18 to $19 per barrel range, with a brief spike to $25 per barrel in late June. And for diesel, around 70% of diesel in China is used in transportation, and another 10 to 20% comes from construction and manufacturing sector, are closely linked to the freight market. So logistics data is a good indicator of diesel demand here. In the next few pages, we analyze demand using operational data from all heavy-duty trucks included and over 12 tons, excluding hazardous goods HDTs. The chart on the left, we can see, shows our weekly heavy-duty truck mileage over the past 3 years. 2024 outperformed 2023 with steady gains, and while 2025 was strong through April but turned negative from May. And by early July, the mileage was around 2% below last year, reflecting the weaker exports, softer consumption, domestic consumption, and limited infrastructure investment. And the chart on the right shows how this trend differs by fuel type. In the index is indexed to 2021 averages. So we can see the pink line is for LNG. LNG heavy-duty trucks have surged since Q2 2023, with average daily mileage more than doubling by June this year. In contrast, the diesel heavy-duty trucks fell to around 80% of 2021 levels. So even though total HDT mileage is holding up, LNG trucks are clearly displacing diesel, adding structural pressure to diesel demand. And let's see why. China's overall logistic transportation capacity is currently in a state of oversupply. Fuel costs account for over 85% of the daily operating expenses for HDTs. So making fuel economics is a critical factor directly influencing the operators' willingness to run their vehicles. The chart on the right compares the unit fuel cost trends between LNG and diesel. Since late March 2023, LNG has consistently maintained a strong cost advantage over diesel, with LNG prices often below 75% of diesel prices, placing LNG well within a strong economic advantage. Under these conditions, more and more fleets have opted to operate LNG-powered HDTs, leading to increases in both the fleet size and actual mileage share of LNG heavy-duty trucks. So the left-hand chart shows the quarterly share of LNG HDTs in total mileage, closely tracking the cost advantage trend of the right chart here. So when LNG's fuel price advantage strengthens, mileage share gains accelerate, highlighting the operator's high sensitivity of to fuel economics and their responsiveness to market signals. And in addition, a clear increase in the operational share of new energy heavy-duty trucks have been observed since early 2025. We can see in the left chart is a green part. This will be discussed in more detail later. By Q2 this year, LNG and new energy HDTs accounted for 24% and 3% respectively of total HDT mileage, up from 20% and 1% in the same period last year. This further highlights how alternative fuel HDTs are rapidly capturing the market share from diesel trucks, driving the declines in diesel demand. So does the rapid growth of LNG HDTs in China's transportation sector directly drive the increased impulse of LNG? To answer this, we need to analyze the regional distribution of this consumption and the source of the LNG supply of this part. So the chart on the left shows a changing share of LNG HDD mileage within total mileage across different regions from 2022 through the first half of this year. The trend indicates that 2024 was the fastest growth year for LNG HDTs, with strong growth continuing into 2025. The three regions with the most significant increase are Northwest, North China, and Southwest, where the share of LNG HDT mileage rose by 15 to 30 percentage points compared to 2022. Notably, LNG HDTs in the Northwest now accounted for over 65% of total HDT mileage. These regional differences are primarily due to the concentration of domestic natural gas resources and liquefaction plants in these areas, well established LNG refueling infrastructure and their status at the major bulk goods transportation locations with higher traffic intensity. In contrast, we can see the East and South China rely more heavily on importing the LNG, which is more expensive, resulting in a much lower LNG HDT penetration rates. Still below, you can see here is below 10% in the first half of this year. And the chart on the right compares the retail price, retail LNG refueling prices between Xi'an and Guangzhou. Xi'an is a city in Shanxi province, the northwest of China, and Guangzhou is a city in Guangdong province in the south of China. So we can see here the LNG price in Guangzhou are around about 20% higher than that in CN, while the diesel prices in the both cities are roughly equal. This means that LNG fuel lacks a clear cost advantage in the east and south of China, limiting its substitution potential. Yeah. So therefore, the current parity indicates that LNG growth in transportation sector is spotted by the domestic regions, not the important LNG demand is limited by this driver. Okay, next let's look at the performance of new energy heavy duty trucks. Currently dominated by the electric models, driven by factors such as China's ongoing dual carbon goals, increased government subsidies since 2024, and the clear fuel cost advantages of fleet size and the operational mileage of new energy heavy-duty trucks have grown rapidly. By the end of 2024, registered the new energy heavy-duty trucks surged 122% year-on-year to around 120,000 units. This momentum continued into 2025, surpassing 180,000 units by June, and expected to reach around 250,000 by year end. And the operational efficiency have also improved, with average daily mileage rising from around 180 km per truck in 2023 to over 230 km in the first half of this year. So this increase is mainly driven by enhanced EV range and the gradual expansion of battery swapping and charging infrastructures. And currently the new energy heavy-duty trucks are primarily used in short-haul settings like ports, logistic parks, mining sites, and industrial routes with limited penetration in long haul transport. Key challenges include the insufficient infrastructure and battery range limitation. However, as battery technology advances and the swapping stations expand, new energy heavy-duty trucks are expected to accelerate into mainline logistics, so potentially replacing the diesel trucks on a larger scale. So this is a critical trend to watch in the medium and long run. And in the first half of 2025, the original mileage of diesel heavy-duty trucks is declined sharply by 7.6% year-on-year, primarily due to the accelerated substitution by LNG and the new energy trucks. So in response, refineries have significantly reduced the diesel yields, driven by three key factors. The first is the weaker margins compared to gasoline. The diesel cracking margins have remained below gasoline, averaging $16 to $17 per barrel as of mid-July, around 13% lower than that of gasoline. And the second is a challenging sales structure. Only around 70% of diesel is sold through the retail stations. The rest serves highly price-sensitive sectors such as large logistics fleet, construction, and mining, such like this. So where intense competition makes it harder for refiners majors to capture full value chain margins. And the third is the rising chemical demand, and the refining to chemicals, lower refine and more chemicals trend. Part of the diesel fraction is increasingly redirected to naphtha cracker as a chemical feedstock, further contributing to reduce the diesel yields. And let's take a quick look at how domestic refiners are doing in terms of profitability, as well as how gasoline and diesel exports have been performing. And according to OCAM data, as of July 10, 10th average margins for major stood at RMB 708 per ton, while Shandong independents averaged just RMB 411. So since 2021, stricter compliance across the entire value chain has steadily squeezed the independents' ability to take advantage of the consumption tax loopholes, especially around, and some inefficient capacity has already been phased out. Even though the overall demand for gas and diesel keeps trending down, majors have managed to hold margins relatively steady. That is mainly thanks to their strong retail networks and integrated operations. And independents, on the other hand, under pressure for from both weaker margins and tighter regulations, and also the weaker demand of downstreams, which explains their low run rates. And from January to July terms, operating rates at Shandong independents were just 46 to 47%, quite lower than historical levels. And key reasons include the tougher upstream policies, like lower CT rebates, fuel oil, stricter controls on non-compliant crude, as well as the weak demand downstream. So in contrast, the major have kept utilization rates at above 75% so far this year, and with most maintenance work now completed and the margins improving in July, the run rates have rebounded to over 80%. And so with wise independents cutting back on their uphold domestic pre-tax wholesale prices for gas and diesel have been somewhat supported. If we compare the domestic pricing with Singapore FOP levels to get the export margins, the export margins for both gas and diesel have been mostly negative through 2025. By mid-July, the average margins for these two products were both below minus MB 200 per ton. Finally, turning to the forecast for second half crude throughput and major oil product exports, taking into account maintenance schedules, the annual processing targets of majors, and downstream product demand assessments, GL Consulting projects a modest 1.4% increase in China's crude throughput in the second half of this year compared to the first half. The full year crude throughput is expected to reach around 728 million tons, up around 1.9% year on year. On exports, we expect a full year gasoline, diesel, and jet fuel exports of 8.4 million tons, 7.1 million tons, and 20.9 million tons, respectively. The total export volume for these three oil products is expected to remain largely flat year on year. For more detailed questions, Mysteel offers a range of regular insights and forecast services, including the month outlook and the weekly report for China oil market. For those interested with the topic of naphtha will be included in our monthly outlook in Q3. We are also considering IPG and fuel oil. And the China policy perspective monthly report on energy transition and decarbonization policy roadmap to help you navigate China's energy and petrochemical market and policy landscape more effectively. And our latest special report is now officially available, helping you to navigate turmoil and thrive in China market with a full package, including a data spreadsheet, a PDF version, and a Q&A session to align with the evolving market environment by providing the most up-to-date data and forward-looking analysis. So if you are interested, feel free to reach out to our team after the webinar. Okay, thank you, Nikki.
Okay, thank you, Amy, for the comprehensive outlook on the China oil market and a deep dive at the changing dynamics in the Chinese domestic market. Now, let's welcome crude oil analyst from Horizon Insights, Zhang Lizhou. Lizhou focuses on crude oil research with in-depth and detailed analysis of the China domestic crude oil market. He has previous experience working at a USD fund and a securities research institute. Lizhou excels in tracking geopolitical developments and the supply structure of crude oil, combining macro and microeconomic conditions to form trend judgments on energy prices. Today, he will take us through the price outlook and trading complexities of crude oil, enhanced by digital intelligence. Lizhou, the floor is yours.
All right, thank you. So, hello everyone. My name is Lizhou Zhang. I'm a crude analyst from Horizon Insight, and today I would like to share with you guys about the price forecast model we are building since the last half of the year. So to begin with, how are we building our price forecast models? So basically, our strategy stemmed from an in-house framework that draws on a core set of data index. So do many fundamental research firms. It can be time consuming and costly to quantify your discourse framework in the past. So our solution is that having an in-house IT team as well as the engineers helping us to building up those models. So here we are showing you guys the step-by-step how we are building up each, let's say, forecast model for WTI for Brent as well as Dubai. But today we're gonna mainly focus on the WTI to give you guys an example. So from the short term, our forecast model result is showing that within the next months, WTI has no trend. The price will be fluctuating between WTI 65 to 70. Maybe experience a short-term rebound, but the upside risk is not too much at this very moment. So how are we doing during the, let's say, past a year? So this chart here shows that it's the back test result we're having through the since last June. So as you can see, the blue line is the actual result, the monthly average for WTI, and the red line is the forecast result. As you can see, our model is quite accurate, and how we backtest it is based on direction and also the deviation rate. So that's how we're backtesting. So to begin with, how are we building those models? So in the past, our way to understand the crude oil price or the factors can be affecting crude oil price into two main parts. The first one is the fundamental. So usually we're using WTI M1 minus M4 and the other side or the other factor, we're using the residual calculations, which you can see the red line is showing on the graph, can be seen as the risk appetite appear on crude oil. So that's the two things we're focusing on and the two things we're actually making predictions. So to begin with, first thing we'd like to share is the risk appetite forecast result. As you can see in the short term, it's still showing a slight improvement within the next months, which means that the risk appetite of peer on market is actually showing a optimistic sign, but it's not too much at this very moment. The reason why these indicators are showing a upward trend in the short term is mainly based on the overall or economic expectation or the traders' expectations. Because during the last months, as we can see, all the assets in the market experiencing a upside terms, but for crude, it's not necessarily happening. So what happened is market is expecting, or the traders expecting, the overall expectation for the overseas economy is actually improving, which leading mainly by two things. The first thing is the U.S. tariffs. The second thing is the rating card expectation. So for the first thing, as you can see, US is making progress with China as well as the EU. And for the second thing, marketing traders are betting on the rating cut in July as well as the September's. So that's the two main drivers why the market sentiment is improving. But however, crude oil is not necessarily simultaneously improving at the same time. The key reason is that crude is different compared to different asset, let's say US star market or copper. Let's take an example, because those those assets are highly driven by the economic expectation. Their manufacturing factors highly contributed. But for crude, a lot of downstream consumption is based on the non-manufacturing side. So that's the reason during those period of time, crude oil price does not necessarily improve, just like the other asset. But the overall sentiment is still looking good. So which means that in the short term, it's not opposing a downside risk for crude oil. So let's say using indicators we have here, most common one we're using is the U.S. Economic Surplus Index, leading by 4 weeks. So in the short term, it's still an upside driver for crude, but it's not a strong driver as we previously explained. So which means that micro is not necessarily giving crude oil clear directions. So our more focus will be on the fundamental side. So for the fundamental, as we earlier mentioned, the key things or key indicator we look at is the WTI time spread, which here we used month 1 minus month 4. So as the predict results showing in the short term is still pretty strong from our angle. As you can see, starting from June, the time spread has continued to increase even after the Iran-Israel war. So, which means that people believe right now for the fundamental of crude is really strong. So why is that? So the clear results we can see is that globally or in US or European, the overall crude oil inventory is really low at this very moment. As you can see in the right-hand chart, which is the Cushing crude oil inventory, is at a really low point within the past 5 years, which has resulted the time spread has continued to increase. But the inventory is the actual result of supply and demand. So the further thing we need to look at how those things going to change later on. So by a simple solution, we are making a prediction for the crude oil inventory. So we are using linear extrapolations for all those factors. For example, net imports, refinery throughout, as well as the US crude oil production. And based on those things, giving us the results just purely from the seasonality performance, the US crude oil inventory will continue to decline, which providing a upward momentum or upward trend for the TI time spread. But as we can see, even though we understand the crude inventory has a really high negative correlations with the WTI time spreads, but the up and down is not fully matched. The reason why is not considering the demand situations. So the next thing we need to look at is the product cracks. So as we can see, the time spread has a really high correlation with the refinery cracks. So which means that if the crack continues to increase, it's definitely gonna drive up the refineries throughout, as well as resulting the crude oil inventory to decline. So that's a negative feedback result. So as we can see right now, the first thing or the key thing we need to look at is the gasoline for US. Because recently it's still in the peak season for gasoline. People are traveling a lot during this season. So is the gasoline crack can continue to increase from our angle. It's hardly to drop at this very moment because still in the peak season. And also from the our model result or the inventory result is showing that gasoline inventory will generally be lower than the seasonality performance. So which means that at this very moment, as the gasoline inventory continues to decline, it's still providing support for the US or the RBOB cracks. So that's from the gasoline angle. But the thing we need to notice that seasonally, the gasoline consumption will generally decrease in the beginning or in the middle of July. So later on, the overall gasoline consumption will continue to decline due to the seasonal performance. At the same time, I believe the US refineries will continue to run at a really high operation rate. The reason is even though gasoline consumption will decrease later on, but at the same time, diesel or the distillates definitely need to fill up their inventory in the short term. So for distillator right now, the situation is overseas, let's say EU as well as US, the overall inventory is still relatively low. Right now, it's the off seasons for those products, and the production or the refinery run rate is really high. But the result we are saying that the overall inventory is still relatively low. The reason why this is happening is mainly due to the shortage of supplies. Due to the OPEC Plus production cut in the past 2 years, the overall medium and heavy grade crude oil is limited in the market. So therefore, European as well as US refineries cannot necessarily increase their distillate yield, which limited the distillators productions. So that's the key reason why the inventory is quite low at this very moment. And later on, if it's cannot continue to increase their inventory, it's almost near its peak season, let's say at the end of Q3 or at the beginning of Q4. So people are currently worried about these situations. And as long as the distillator are not necessarily increase their inventory really fast, it definitely gonna support the run rate as well as the crude oil inventory to draw down, eventually providing support for the time spread, doesn't matter it's TI and Brent. So that's our view from downstream products for all those three things: gasoline, distillator, as well as jet fuel. Currently, the inventory expectation is relatively good. So, which means that it can providing a positive feedback towards crude oil. So the inventory expectation is still looking good, as well as the TI time spread expectations. So based on those things, we are giving out that from a monthly scale range, we estimated WTI will be fluctuating between WTI 65 to 70. For Brent, is 67 to 72. So that's our view and our price forecast model I'm sharing today. And that's end of my part.
Okay, thank you so much, Li Zhou, for the sharp directional views on prices. It's refreshing to see how the power of digital intelligence can enhance our investment decision making today. Now, let's shift our focus to the refined oil product side. We are excited to welcome oil products analyst at Horizon Insights, Joe Au. Au is primarily responsible for research on gasoline, diesel, and fuel oil. He previously worked as a procurement engineer at a listed company and served as an energy and chemical researcher at Everbright Futures for 4 years. Au excels in uncovering details within the energy and chemical industry chain, using comprehensive data and rigorous logical analysis to identify trade opportunities. He will share the directional views on the price on the refined oil products. Au, the floor is yours.
Thank you. Okay, good afternoon, everyone, and I'm gonna share my views on the oil product side. So let's firstly, I'm gonna talk about what our digital transformation starting from the second half of last year. So from the H2 of the 2024, for Horizon Insights, we cooperate our analysts' works with the AI models. For example, we select some indicators which we think have a huge impact on the trend of the commodities prices or fundamentals, etc. And we provided these indicators to our programmers, so they will build some AI forecast model for forecasting the price trend. And in the future, we're gonna continuously refresh our forecasting models and make sure our forecasting results are accurate. So let's firstly, I'm gonna share my Shandong gasoline crack forecasting framework. So we usually selected 4 categories of indicators to build the gasoline crack AI forecasting models. So first is about the macro factors, and the second part is about the crude oil prices, and the third is about the fundamental factors, and the last is about the sentiment factors. So you can see these 2 charts. We select some high frequency indicators which can reflect in the total macroeconomic situation in Chinese market, such as the Asia's market performance and the Chinese economic surprise index. We can find that in the history, there's a highly positive correlation between the macro factors indicators of the with the Shandong gasoline cracks. And the second part is about the crude prices, because we think that there's divergence between the crude flat price and the Shandong gasoline flat price. So because of the volatility of the gasoline price is much lower than the crude oil price. So when the crude oil sharp increase in a short time, then will make the gasoline crack be possibly constructed. So we think you can see the relationship between the IC Brent crude fat price and with the Shannon gasoline crack is negative. So we also have to take consideration about the performance of the crude oil price. And the second part is about the fundamental factors. Because you can see we use the year-over-year change in the percentage of the inventories at Chinese independent refineries as a fundamental indicators to forecast our gasoline crack. You can see the red line is leading the trend of the blue line, which is the Shandong gasoline crack. So this is fundamental factors we use in our forecasting models. And the last part is about the sentimental factors. We usually use the gasoline social inventories month-on-month change as indicators of the sentiment index or the speculative demand for the gasoline market. Because when the Shandong traders inventories going higher, that means that for the traders, they are more optimistic about the future markets. So they are willing to build the inventories, and this will make the gasoline cracks going higher. So we usually use the sentimental indicators as factors of for our forecasting work. So this is our final results about the AI model forecasts about the Shandong gasoline crack. You can see that within the next months, generally the Shandong gasoline crack will maintain a downside trend, but the room for the decline is quite limited. It's much fluctuating within this range. So this is our focus about the gasoline crack. The second part is about the diesel crack. Just like the gasoline, we also use 4 categories of indicators: macro factors, crude price, fundamental factors, and sentiment factors. About the macroeconomic factors, you can see we select the Shandong exchange rate and the China to US bond yield spread as indicators of the macroeconomic situations. And about just like the gasoline, we have to consider the performance of the Brent or WTI crude oil price performance when we want to forecast the trend of the diesel crack. And this is about the fundamental factors. Not only we must take care of the fundamentals of diesel itself, and you can see we select some diesel productions as the indicators of the fundamental factors, and we must take care of the other industrial commodities such as rebar steels, because in China the rebar steel have been used to the real estate sectors and the manufacturing sectors, just like the diesel. So we think that there is some positive correlation between these two commodities. When the demand of the rebar steel going higher, that means that maybe simultaneously the diesel demand will have a good performance. So we use the rebar futures prices performance as indicators of the Shandong diesel cracks. And we also take the Nanhua Industry Product Index as another indicators. And we also take the inventories situation of the diesel as the indicators. So this is about the fundamental factors. And the last is about the speculative demand, just like the diesel, just like the gasoline. We also take the Chinese diesel social inventories change as indicators about the speculative demand. So finally, we take the results of the diesel crack in the future. Within the next month, we can see we are a little bearish about the performance of the Chinese diesel crack. It seems like the downside room is larger than the gasoline crack. So maybe in the next months, we are more bullish about the gasoline crack's performance, while more bearish about the diesel crack side. So this is about the forecast about the refined products cracks. The third part is about the fuel oil side. For forecasting the Singapore's high sulfur crack, we usually take 4 categories of the indicators. The first is about the petroleum products margins, and the second part is about the fundamentals of the medium to heavy crude oil, because we believe that when we want to study the high sulfur high sulfur fuel oil market, not only we must analyze the high sulfur itself, but also we must get some research on the fundamentals of medium to heavy crude oil, because we can find a lot of relationship between the medium to heavy crude oil price performance with the high sulfur crack. And the third part is about the fundamental factors of high sulfur itself, and the last is about the economic viability of the power generation while using high sulfur oil. Recently, we can see the overseas refined oil profits, especially for European diesel cracks, performance is quite strong, and is much stronger than the performance of the domestic market. So we think that because the overseas refined oil profits is stronger than the performance of the domestic market, I think it will be bearish for the high sulfur crack. The logic behind this is because for Shandong Teapot's refineries, they usually use the high sulfur oil as some feedstocks. So when the domestic margins or the Shandong refineries margins going higher, that means that maybe they will import more fuel oils as feedstock. So that will give some bullish support for the high sulfur crack. But for when the overseas refined oil profits going higher, that means that because the high sulfur crack, high sulfur fuel oil usually play a role of the byproduct of the overseas refineries. So the overseas refineries margins going higher, that means that they will produce more refined products while also produce a lot of fuel oils. So that means that the overseas supply of the fuel oil will become much more than the previous levels. That will hurt the valuation of the high sulfur fuel oil. So we can find there's a quite a highly positive relationship between the high sulfur crack and the diesel export profits from China to Singapore. So, and this is our AI forecasted results about the Singapore's European diesel crack and the Shandong diesel crack. You can see that for the overseas market, not only in the Singapore and but also the European market, their diesel crack is still performs stronger than the Shandong market's diesel crack. So we think that this will still hurt the valuation of the high sulfur fuel oils. And in the long run, we think that the accelerated pace of the OPEC plus crude oil production will hurt the valuation of the medium to heavy crude oil valuations. So we think that you can see there's correlation between the high sulfur fuel crack and the price spread between Brent and Dubai. So when the performance of Brent crude oil prices is much stronger than the Dubai, that means that the light crude oil, the price spread between light crude oil to medium heavy crude oil will widen, and that will hurt the high sulfur fuel crack. And because in the history, when the OPEC plus increase its crude oil production, that means that maybe there's possibility. Is it possible that the Brent to the price spread between Brent and Dubai will widen? So we think that maybe in the second half of the year or in the first half of the next year, when the OPEC plus increase all of the crude oil production, the plant. So the Brent medium to heavy crude oil valuation will be hurt, and which is more bearish on the high sulfur crack side. And recently, the supply of the high sulfur fuel within the Singapore's market is quite ample, and we think that in this summer, the performance of the power generation demand of the high sulfur fuel oil is below expectations because previously the crack of high sulfur fuel oil is high enough, so the economic viabilities of the power generation for high sulfur fuel oil is quite low. So, and in this year, the temperature of the Saudi Arabia is much lower than the past 3 years average levels. So that will still all these factors hurt the performance of the power generation demand of the high sulfur fuel in this year. So in recently, the Middle East has exported a lot of fuel oils. So that makes the Singapore's market supply more ample. So we think that maybe in the last 2 months, we successfully predicted the downside decline of the high sulfur crack. And maybe in the short term, we can forecast there's still a little rebound, but we think that the rebound level is quite limited. And in the long run, we still maintain a bearish outlook about the high sulfur fuel crack. And the last part is about the low sulfur fuel crack. We just like the high sulfur fuel oil, we select the CP margins, macro factors like to have crude prices, spread, and the fundamental factors to forecasting the low sulfur fuel crack. Recently, there's a decline in the low sulfur fuel crack because there is an increase in the low sulfur supply. You can see a lot of blending components from the Sudan. So the Sudan dark crude oil export volumes going high in the last 2 months. But we think that we can still find some support from the refined oil products margins, especially for diesel. We have introduced. We maintain a bullish outlook about the overseas diesel crack in the next months. So we still can still find some support for the low sulfur fuel crack side. And unlike the high sulfur fuel crack, so we can find some positive relationship between the low sulfur fuel crack with the price spread between light and heavy crude oil. As we just said, in the long term, as the OPEC Plus has accelerated its crude oil production, that will hurt the Dubai crude oil price performance. So we think that when the light to heavy crude oil price spread become much larger, and the low sulfur crack will find some support from these indicators. And the last part, we usually, because the low sulfur fuel oil is primarily used marine fuel, so we also select some macro factors to predict the low sulfur fuel crack's performance. Such as a super seasonality of the U.S. economic surprise index and the ship account to the United States from some key countries. So finally, we can get the forecasted results for the low sulfur fuel oil. In the next months, we still more bullish about the performance of the low sulfur fuel crack. And finally, about the hedging strategies with these two commodities. So because we are more bullish about the diesel crack's performance in the overseas market, so generally we can see there is a positive correlation between the diesel crack and the high-fi spread. So we think that compared to long the low sulfur crack, I think we are inclined to recommend our clients to long the high-fi spread in the next months. And maybe in the second half of this year, we are generally maintain the bullish outlook about the high-fi spread performance. So that's all I want to sharing today. Thank you.
Thank you, Al, for your comprehensive view and insight. The dissection on oil products directional forecast gives us a clearer understanding of what to expect moving forward. Now, we'd like to open the floor for questions. Please remember to submit any questions you have in the Q&A box. We will do our best to address as many as possible in the last 10 minutes. Here is a question about addressed to Mysteel, Amy. So with Chinese diesel cracks low while Western cracks being high on low inventory, what prevents China from exporting more diesel to the West?
Okay, thank you. As I presented in the earlier, and this year the independent refineries have been facing several challenges, and many of them have kept their run rates low. And those that mainly processed the fuel oil or diluted bitumen, typically producing higher diesel yields, have either cut their runs throughput or shut down altogether. So as a result, the diesel output from the independent has dropped quite a bit. And at the same time, we observe that major refineries concentrated their maintenance turnarounds in the Q2, and also diverted some diesel range material into petrochemical feedstock as part of the ongoing refinery to chemical shift. So this also reduced the overall diesel use. So on the whole, China's diesel supply has tightened notably, and some regions experienced some supply pressure. Supply is limited, so the export and on the export side, we can see the margins have been negative through the first half of this year. So we had kept the exporters on the sidelines with very little incentive to ship the diesel out. Yeah.
Okay, thank you, Amy. The second question goes to Horizon. Zhang Lizhou, any recommended trading strategies for crude oil market now?
All right. So my recommended strategy would be long WTI time spread M1 minus M2. That's one safer strategy for now. Another thing would be long diesel crack or just on diesel spot price. The key reason is that we believe the crude oil is already hitting the lower boundary of our price range. So at the same time, we are holding a positive or optimistic attitude towards the diesel situation overseas, especially in the EU market. So that's the reason why we believe long Europe diesel crack or diesel spot price will be a better suggestions in the 1 month scales. So that's my answer or recommended strategies for now.
Thank you, Li Zhou. Yeah, let's see then. So here comes the last question, because we are kind of running out of time. Because Zhou Ao introduced quite an interesting model, and this question comes as that, can AI forecast model replace the human researchers?
Yeah, that's a very interesting question because everybody worries that once the AI development quickly is that everybody worries their work. But I think within the commodities research region, we think that as I just said, for building our AI forecasting models, the first step is that our researchers select some indicators to our programmers, and then they will build the AI forecast models. So I think humans still play an important role for the AI models. And once we find that the results we forecasted is wrong, only rely on AI itself, it can't find the what is wrong and how to change the models, because their models they build are largely depend on the historical data, and they can't quickly find the factors that the markets are trading. So still rely on our humans to select some indicators we think that the largely has large influence on the price trend currently. So I think in the future our humans still play an important role for the price spread price trend forecast, and there's collaboration work, collaboration shape within the AI and the human, not not a competition
True.
situation. It's a
Yeah.
collaboration. Yeah.
True. I reckon the same because now AI can do a lot of work and save human beings time, but every human has its own subject matter expertise to recognize what is right and what is wrong. And as you said, that most of the big data available there is the history, and so all the models are based on the history. But now we are seeing quite a lot of chaotic and also uncertain market. I would say, yeah, I really reckon that, but I also look forward to a research and analysis road with more AI involved. All right, everyone, that concludes session 2 of the Midway Mark, Reflection and the Road Ahead for 2025. Thank you to all our speakers for their valuable insights, and thank you all for joining us today. We will be back next Tuesday and Wednesday for session 3 and 4, where we will dive into key supply and demand drivers, price trends, and provide both macroeconomic tech context and tactical trading strategies to guide informed decision making for the next half a year on ferrous materials, copper, and lithium carbonate. Have a great day ahead, and we look forward to seeing you again next week.